What is a capital stack and how does it affect you as a passive investor? Today I'll walk through what a capital stack is in a multifamily investment, why it matters, and if you stick around to the end, I'll share a quick illustration of what it looks like. The term capital stack sounds intimidating on the surface, as do many terms related to real estate investing. But just like those other terms, it's really simple to understand once you take a harder look. A capital stack represents the sources of money you need to buy a property. That's it. And the reason those sources of money are referred to as a stack is because each layer of that money serves a separate purpose in the deal and has a certain level of risk associated with it. Let's dive in a little further. At a high level, when you purchase real estate, more times than not, you need debt and you need equity. Debt is usually the biggest source of money being contributed from a lending institution, and equity, a slightly smaller portion, is on the deal sponsor operator to bring to the table, usually raised from investors. Debt is being lent and needs paid back with interest, and equity has ownership rights in the deal and is projected a return on that equity based on the asset's performance. Think of equity just like you would a down payment on a house, and the bank is putting up the rest. It's the exact same concept. Now, with bigger assets like a 200-unit apartment building, these layers of debt and equity can get a little more complex since it's a multi-million-dollar purchase. So to keep it as simple as possible, the first layers in this stack, serving as the foundation, will be the debt components. Sometimes there could be more than one layer of debt, and in that case, it would be referred to as senior debt at the very bottom, and then next junior debt. In today's lending environment, senior debt will make up anywhere from 50 to 60% of the purchase price. So if there's a $10 million asset to be purchased, the senior debt might be capitalizing around $6 million of that asset. The reason it's important to distinguish between senior debt and junior debt, if junior debt exists at all, is because each layer is prioritized differently if a sale, refinance, or even foreclosure occur. You might have already guessed it, but senior debt is always in the first position since they're loaning the largest sum of capital. This debt is in the lowest risk position in the entire capital stack, and right behind it would be junior debt if it exists. Following the debt pieces of the capital stack, now we get into the equity layers. The two main types of equity are preferred equity and common equity. Preferred equity is in a stronger, less risky position in the capital stack than common equity, and it can sort of act as a hybrid between a loan and equity. Now, there are a lot of different ways that preferred equity terms can be drawn up in a deal, which we won't get into, but the takeaway here is that if your sponsor takes on third-party preferred equity, it will take priority in the capital stack to common equity. And that's important because common equity is what you will be investing in as a limited partner. You may have heard me talk about a preferred return in previous videos, which is the return you must receive as the passive investor before the sponsorship team shares in the profit. A preferred return can and still should apply to you as a common equity investor, but don't get it confused with thinking you're in the preferred equity position. If a preferred equity lender is involved in the deal, their entire capital source is paid out before you are as a common equity investor. So to recap, take a look at this chart to help illustrate the capital stack. First, I want to be sure to give credit to AB Capital for creating this, so thank you for drawing it up. You can see here the four layers we discussed, and the way you should be thinking about this is highest risk capital at the top to lowest risk capital at the bottom. Starting at the bottom, senior debt is in the least risky position and is paid back first in the event of a sale, refinance, or foreclosure. Next is junior debt, or what they note here as mezzanine debt, which is a type of junior debt product, and that's second in priority to the senior debt. And finally, getting into our equity pieces, we have preferred equity and common equity, which is what you, a passive investor, will most likely be investing in. After learning about the capital stack, you may be asking, why not just invest in one of those less risky layers? That's a fair point, and there are definitely funds out there that exist where you can get involved in less risky sources of capital. But the takeaway to note is that your expected returns will reflect that lower risk, meaning they won't be as high. When you see return metrics of any sort, it doesn't have to be in real estate, The next question that you should ask yourself is, what is the risk I'm taking to earn this return? Therefore, in a common equity position, although you're in a higher risk layer of the capital stack, it also has the biggest potential upside. So another way to think of the illustration that we just looked at is as we climb the stack from the bottom to the top, the risk increases, but so do the return projections. Starting out, you don't have to be intimately familiar with every single one of these components and know every single detail, but this breakdown can help guide a general conversation you have prior to investing in a deal. Simply requesting to the deal sponsor, hey, please walk me through how this deal is being funded, or please walk me through the capital stack, will allow you to start to see how many layers come before your equity investment, and then from there, determining how risky the deal is. To give an extreme example, if a deal has no debt and is purchased with all cash or 100% common equity, that's far less risky than a deal with senior debt, junior debt, preferred equity, and common equity. In that latter example, there are so many people who need to get paid back before you end up getting your cut. So I hope this breakdown was helpful, and if you have any questions, feel free to comment below or reach out to me directly. Thank you.